GDXY has been part of my high-yield income engine, but there's a new AI-driven ETF that doesn't just generate income, it changes the way I think about total returns inside a dividend portfolio. Let me get right to it. This is GDXY. This is the YieldMax Gold Miners Option Income Strategy ETF. Currently, I have 175.47 shares. I have an average cost of $15.54, and it is trading at 1088. It is down. It is down huge. If I take you over, you can see now my market return is minus 817.69. My total return is down 7.20%. And even with a dividend yield of 71.63, it is still, the annual income is 1426.57. But here is basically why I am reconsidering my positions. Let me take you to my dividend log. That is GDXY. I've only had it since October of 2025. As you can see, my income was actually going up, and now it is starting to go down. So it is not doing the job I needed to do. So I am considering something new, and that new ETF is GPTY, and it's starting to redefine what belongs in my income strategy when time is limited and compounding speed actually matters. When you're building a retirement portfolio with a limited timeline, you don't get the luxury of waiting for macro conditions to eventually reward every position equally. You start to realize something important. Not every ETF deserves to stay in the income engine forever. GDXY has played its role as part of my high-yield structure, income generation, diversification, and gold exposure as a defensive layer. But the portfolio isn't static anymore. It's evolving towards something more efficient. That's where GPTY enters the picture. Let's go over to Seeking Alpha. Seeking Alpha is basically my source for ETFs and stocks. So if you're following a similar income to retirement strategy, hit like and subscribe. I'm showing real-time portfolio decisions, not theory, not model portfolios, actual allocation changes as they happen. GDXY's job in my portfolio was never complicated. It served as a high-yield income contributor, a diversification layer against equity volatility, a stabilizing force within a more aggressive ETF mix, and for a time, that role made sense. Because early on, the goal was simple: build income streams quickly across multiple assets. But as a portfolio matures, the question changes. It's no longer just how much income does this generate, it becomes how efficiently does this position contribute to both income and long-term compounding. This is the dividend yield for GPTY. As you can see there, the current yield is 32.84. My dividend growth rate, it's only been a year, but that is pretty impressive. That is the dividend yield and the annual payout. It pays weekly just like GPTY. And it is the YieldMax Allen Tech Portfolio Option Income ETF. So how efficiently does this position contribute to both income and long-term compounding? And that's where the structure begins to shift. I'm going to take you to momentum, which is basically what you need, your metric to try to find what is working in your portfolio. GPTY is built on a different foundation. Instead of relying on traditional defensive or commodity-linked income structures, it leans into AI-driven growth exposure while still maintaining an income profile. And that combination changes the equation, because now you're not only choosing between income stability or growth exposure, you're blending both inside a single position. Now, if you go into momentum here, this is price return. What you're going to do is you add GDXY. Here it is. That is the YieldMax Gold Miners Portfolio Option. And as you can see, price return, GPTY is basically walking the floor with GDXY. GPTY is just doing the job that I needed to do, even At a 5 year, it's still drawn down a lot less than what GDXY does. And if you bring it down here to total return, which is a huge metric for myself, that is telling you what your dividends and your price appreciation are adding up to. So GDXY. And now the comparison there. This is your 1 month, your 6 month, your 1 year, and your 5 year. Is beating GDXY on all those accounts, and you're getting price appreciation as well. So what stands out with GPTY is not just yield, it's how it behaves relative to total return. It introduces stronger price appreciation potential, exposure to AI-driven sector momentum, income generation layered on top of growth assets, and more modern total return income structure. And in a portfolio where time is limited, that combination becomes difficult to ignore because compounding speed matters more than theoretical stability. If you're thinking about ETF income differently now, more total return focused rather than pure yield, comment below and tell me what matters more in your portfolio right now, income stability or growth acceleration. And this is where the real change happens. This isn't about saying one ETF is bad or one is good. It's about role efficiency inside a portfolio that is actively being optimized. GDXY represents a traditional high-yield structure, defensive positioning, income-first logic, macro-dependent performance profile. GPTY represents a newer structure, growth-aware income design, AI sector exposure, total return sensitivity, compounding efficiency inside an income sleeve. And when you put these side by side, the distinction becomes clear. One is designed to preserve and distribute. The other is designed to compound while distributing. And in a retirement timeline that is tightening, that difference becomes a deciding factor. At a certain point, portfolios stop being about accumulation and start being about optimization. I'm no longer just building income streams. I'm refining what income streams actually accelerate the end goal. And what GPT represents, it's not just another ETF addition. It represents a structural replacement in how I allocate capital inside the income structure. Not because GDXY failed, but because the role it once filled is now being handled differently going forward. This is what portfolio evolution actually looks like in real time. If you want to see how this affects my broader ETF income structure, including Roth versus taxable allocation, subscribe because the next update breaks down exactly where the capital is being shifted next. GPTY doesn't just enter the portfolio as another holding. It changes the criteria for what belongs in the income engine. GDXY helped build a foundation, but now the focus shifts towards positions that combine income with stronger total return dynamics. And that's where GPTY starts to take precedence, not as a replacement announced loudly, but as a structural shift that reflects where the portfolio is heading next. Because at this stage, the goal is no longer just income. It's income that compounds faster than the alternatives. If you found this breakdown useful, like, subscribe, and let me know. Are you still easy for me to say, prioritizing defensive income ETFs or moving towards total return income structures like GPTY? Now, if you stick around, you can watch this video where I talk about dividend yield traps. They do exist, but I gave them a job. I gave them a job to do. GDXY is considered by a lot to be a yield trap, but I gave it a job. It was providing income. It was doing the job for me for a while, but that situation looks like it's changing. But there are other dividend yield trap ETFs out there. I go over them, and thank you for watching, and until the next time.